Hello, Professor. This is khilmeenseok, and the title of my replication research is Executive Compensation and Capital Structure, the Effect of Convertible Debt and Straight Debt on CEO Pay. Actually, at the beginning of the semester, I chose different paper, but the database in the paper was not possible to access, so I tried to find different paper that use data I can get. I have interest in the pecking order theory and agency cost of capital structure, so I tried to find a paper in this area. Even though this paper was published in Journal of Accounting and Economics, but the topic is still interesting in terms of behavioral finance view, and as the data includes CompuStat, CRSP, and Executive CompuStat, which all important database for finance research, so I thought replicating this paper would be very helpful for not only studying for future study, but also understanding agency problem for me. Then I will start from now on. Here is the table contents. First, introduction. Second, hypothesis of the paper. And third, data and empirical approach. And fourth, replication including compare and contrast. And five, main results. Six, conclusion. And seven, research idea. Modern agency theory suggests that a firm's financial structure can affect the agency relationship between shareholders and managers, and also conflicts of interest between shareholders and bondholders. However, studies of executive compensation typically ignore the role of firms' capital structure. This paper shows that capital structure matters in setting executive pay and sheds light on the nature of this relation. The author's hypothesis consists of three parts. The first hypothesis, the author called independent hypothesis, and it explores null hypothesis of capital structure and CEO pay are not related. By exploring this hypothesis, this paper shows that capital structure matters in setting executive pay. The second hypothesis is the agency cost of equity hypothesis. The agency cost of equity hypothesis suggests that debt mitigates shareholder-manager agency problems by including lenders to monitor, reducing the free cash flow available to managers, and forcing managers to focus on value maximization when facing the threat of bankruptcy. In addition, it suggests that managers' incentives are driven by the need to mitigate not only shareholder-manager but also shareholder-bondholder conflicts of interest. When managerial and shareholder interests are closely aligned, managers have incentives to choose investment policies that benefit shareholders at the expense of bondholders, that is agency cost. Shareholder-bondholder conflicts are more severe in more leveraged firms, so these firms may find optimal to reduce agency cost by inducing a lower incentive alignment with their managers. So the author examined whether if higher debt mitigates the severity of agency conflicts between the firm's manager and its shareholders, then CEO pay performance sensitivity should be decreasing in leverage. Third hypothesis is the agency cost of debt hypothesis. Some researchers found out the role of convertible debt. The agency cost of debt can also be reduced by using convertible debt. Even firms with convertible bonds and straight debt have similar debt ratios, but the difference is firms with convertible debt in their capital structures differ from firms with straight debt in that they have used security designed to mitigate the agency cost of debt. So, if compensation is designed not only to mitigate agency conflicts between managers and shareholders, but also between shareholders and bondholders, then CEO pay performance sensitivity should be decreasing in leverage due to straight debt and higher in firms with convertible debt. In this paper, the data is merged from three databases: executive compensation data from ExecuComp, accounting variables from CompuStat, stock returns from CRSP. For data handling, the author explains that they excluded companies in the financial sector, firms without enough historical data of 5 years to calculate reliable measures of stock price variance in CRSP, and they restricted attention to CEOs in firms with long-term debt outstanding in at least 1 year during the sample period. The data sample period was from 1993 to 1999. So when I handling data for replication, I try to follow the author's mentions here. From now on, I'd like to talk replication process of mine. As mentioned before, data came from three databases, Executive Compustat, and CRSP. So I tried to create variables using each database and merged it. In the executive compensation data, I calculated 5 variables. To be honest, as this paper's explanation for data collecting and creation of variables were not kind enough, so there is no option for me but to use my guess and estimation to create variables and trimming. Flow compensation was sum of salary plus bonus plus other annual compensation plus long-term incentive plans plus restricted stock grants plus option grants plus all other compensation. However, as there are many missing variables in each data, I replace missing variables into zero. I think replacing is not a correct direction. However, there is no choice but to replace to sum up those variables that I collected. Change in value of stock is defined as annual dollar change in the value of CEO's equity holdings. There is no enough information as well, so I collected stock unvested bar, which was defined as restricted stock holdings in value from executive Compustat. As the same way like above variables, I used annex extra EST var, which is defined as estimated value of the in the morning of unexercised exercisable option to calculate change in the value of options. There is no information what item I should collect from the database, so I chose the most close data I can guess. Finally, I could replicate the summary table 1. However, the result was a little bit disappointing. The main reason of difference is, I guess, the process that I replaced missing data into 0. I was trying to solve this problem by not only replace missing data, but I couldn't. Another reason of difference may be I collect different items from the authors. However, as there is no clear information regarding what items to collect from Executive Compustat, so I have no choice to clarify what is the author's collected item by myself. Here is the capital structure data part. Here, the all firms summary results of mean and median, mean and max was not that much different from the original table. However, in the section of leveraged firms with straight depth and only part, the observation number and mean, median, and max values has big difference. In the paper, the straight depth was defined as book value of convertible long-term debt. However, there was not the exact item in the Compustat, so I used DN, defined as debt note items instead. However, the number of matched items was so small. Here is the regression model. The regression for second hypothesis is not that much different, but only includes some variable. The author in this paper used empirical approach of Agarwal and Samwick 1999. The regression was two-stage regression. The F sigma squares and F size and F MTBR variables are all CDF of a variable, so I used cumul command to calculate the variables. Here the author used MR and 2SLAD regressions. MR regression, according to my understanding, is median regression, which use median value of dependent variables. For 2SLAD, the author defined as a process done in order of OLS first and MR later. I generated all the variables used in this regression. However, I couldn't finish MR and 2SLAD regression because the error message of convergence not achieved. I tried to figure out this reason, but I couldn't. So from now on, I'd like to explain the author's results of each of hypotheses. The first hypothesis was about financial leverage matters in setting CEO incentives, and the second hypothesis is if higher debt mitigates the severity of agency conflicts between the firm's manager and its shareholders, then CEO pay performance sensitivity should be decreasing in leverage. Here, the author expects capital structure matters in setting executive pay and expect that both the agency's cost of equity and the agency cost of debt has negative relation between pay performance sensitivity and financial leverage. The regression was same as the equation in the previous page, and the important factor is gamma in the second stage regression. The table of answers show in 6 columns for the robustness and thorough examination. You can see the coefficient of R cross F sigma square term. The finding is that pay performance sensitivity decreases in leverage and capital structure has effect on the provision of managerial incentives. The third hypothesis is regarding the question that can stockholders, bondholders conflicts explain the lack of incentives? The agency cost of equity hypothesis predicts a negative association between managerial incentives and leverage. So, for the agency cost of debt hypothesis, pay performance sensitivity should be decreasing in leverage due to straight debt, but higher in firms with convertible debt. This is the regression model, and the author includes LS and LC. LS is leverage due to straight debt, which is book value of straight debt divided by the market or book value of assets. And LC is dummy if the firm has convertible debt outstanding. Here the gamma is negative and pi is positive. From this test, the author distinguished between the agency cost of equity and the agency cost of debt hypothesis. The negative effect of straight debt and the positive effect of convertible debt on pay performance sensitivity provide strong support for the agency cost of debt hypothesis. This is the result of this paper. Debt affects the provision of optimal incentives to manager because it mitigates shareholder-manager conflicts. The agency cost of equity hypothesis. That optimal incentives dependent only on agency relation between managers and owners, but also on the agency conflicts between owners and lenders, the agency cost of that hypothesis. The research idea. I'd like to explore the idea of this research by focusing on industries or region. As CEO compensation is highly related to firm performance, and there are still different views regarding firm performance and capital structures relationship. Rahman et al. 2007 found a significant capital structure effect on the profitability for non-financial firms listed. The author used data in listed textile sector of Bangladesh as a proxy for firms that use external debt as a source of finance with no sufficient internally generated funds, and found out a significant negative relationship between leverage and firms' profitability. Arbor 2005-6 to investigate the relationship between capital structure and profitability of listed firms on the Ghana Stock Exchange, and found a significantly positive relation between the ratio of short-term debt to total asset and ROE and negative relationship between the ratio of long-term debt to total assets and ROE. However, Saidi et al. 2011 found that there is no significant relationship between ROE and capital structure when they used 4 performance measures and 3 capital structure measures. By focusing on specific industry or region, I expect to scrutinize the relationship between capital structure and executive pay. Thank you for listening. This is the end of my presentation.